Imagine a trade you can look for every single day. No rare patterns, no waiting for perfect conditions, just one repeating event, the market's opening. This is the opening range breakout, and today I'll show you not only what it is, but how to refine it into something far more powerful. At its core, the opening range breakout, or ORB, begins with the market's final movements after the open. We use the New York session open as the reference point. We define a window of time, perhaps the first 5, 15, or even 30 minutes after the open. Within that window, price sets its initial high and low. That box becomes the opening range. And here's the key. It's not the range itself we trade, it's the break. When price moves beyond the high or the low of that defined range, the breakout becomes our potential trade. The ORB is elegant, but it's also unrefined. A simple break of the range can lead to false starts, traps, and whipsaws. To sharpen our edge, we need more context, confirmation, and structure. So let's explore 3 refinements: fair value gaps, volume profile, and delta. Each one offers a different lens, a different way of filtering the breakout for higher conviction. The first refinement, fair value gaps, or FVGs. A fair value gap appears when momentum leaves behind an imbalance in price. Technically, it's a 3-candle pattern, a strong impulse candle, a follow-up, and then a third where the wick of that bar fails to fully overlap the first. That empty space is the gap. Think of it as a low-volume pocket, a place the market often revisits before rejecting. So how do we use it with the ORB? Once price breaks out of the opening range, we wait. If that breakout leaves behind a bullish or bearish fair value gap, and price retests that gap, the rejection becomes our entry. It transforms the simple breakout into a breakout with context. Fair value gaps show imbalances across candles. But what if we want to look deeper, inside the candle? That's where the volume profile comes in. Standard volume only shows activity over time. Volume profile maps trading by price. High volume nodes reveal areas of balance where market participants agreed on value. Low volume nodes, the thin spots, reveal rejection zones, where price moved too quickly to build structure. Applied to the ORB, the logic mirrors the FVG. Price breaks out of the opening range, then leaves behind a low volume node. On a retest, if price rejects that node, it often confirms continuation in the breakout direction. The final refinement is delta, the difference between aggressive buyers lifting the offer and aggressive sellers hitting the bid. It tells us who's truly in control. A strong positive delta during the upside ORB suggests real buying pressure. A strong negative delta during a downside ORB signals aggressive selling. But there's the nuance. Delta must align with price. Strong delta with no movement means absorption. Larger players are absorbing orders, often foreshadowing reversal. So in practice, when price breaks the opening range high and delta confirms with strong positive numbers, that's conviction. When it doesn't, caution is required. The opening range breakout is timeless, but with refinements, fair value gaps, volume profile, and delta, it becomes more than just a breakout. It becomes a structured approach to finding conviction in the chaos of the open. If you found this breakdown helpful, sharpen your edge by subscribing. I'll be diving deeper into targets, stops, and more advanced strategies in future videos. Until then, stay sharp, trade smart.